and how to defend those penalties. So with that, let me start off. So what we're going to do is, give a bit of regulations quickly, and then get into what the 3CEB is about, just to kind of get into a little bit of, overhauling of, everybody's knowledge. And then we will dive into the key issues. And what I've done is I've gone clause by clause so that, even though I might just, go quicker over some of the clauses, you have the opportunity to, kind of think through your client situations and pose some questions on that. And then there are other key aspects that I would like to just highlight. And from there, we will take into the summarization of what we need to do as professionals. So starting with the TP regulations, this TP regulation starts from 92E, as we all know, and just the definition of what it means is all there on the screen. So every person who has an international transaction or a specified domestic transaction will need to furnish a report, and that report has to be certified by a chartered accountant or an accountant, as it may be. Now there are obviously some nitty-gritties here in terms of what is specified domestic transactions, and on a lot of you might be grappling with that, and we'll come to that in a while. There are also issues on what is an international transaction itself. There have been now new definitions of deemed international transaction. So we'll have to get into that. That is also a new clause that has been added. So we have now a new form that has just been, issued by the Finance Ministry and the CBDT. But there is still something that is left, and we'll come to that as well. The due date to sign this and file is 31st October, which is like 12 days from now, or 13 days from now. So it's pretty much there at this point. As I mentioned, it might just get extended, but that's something that we have to kind of grapple with for the moment. So time is short, friends. We have to go a little quicker on our compliances, ensure that our clients give us the details, and we can get done as many as we can before 31st October, because the extension might come just right on 30th or 31st of October. Okay, so let's go with some of the issues that we might look at. So there is no threshold for filing Form 3CEB for international transactions. So even if one has a transaction of just ₹1 international transaction, the taxpayer has to file a 3CEB. For specified domestic transactions, yes, there is a value which is 20 crores, and only if you exceed in aggregate the 20 crores, you need to file 3CEB. If you have only specified domestic transactions, of course, with that, a smaller SDT number, if you have international transactions of more than ₹1, you still have to do 3CEB. So that's one part of what needs to be done, and there are always issues on this aspect itself. But let's go to the next part of it. What if you don't do, and what if somebody misses? And we talked about that. So there is a penalty under 271AA at the rate of 2% for missing out on a transaction. So if you do not report a transaction, then what happens? And this is something that will come as we go through the session today, as to if you cannot identify and you do not put in a transaction, what will happen is that 2% could come into play of the transaction value. And for larger transactions, if you miss out, that 2% could be very, very big. So that's something that we need to all look out for. there is also a penalty of 1 lakh for non-filing. Now there is a peculiar question that kind of keeps on coming, that rather than having the 2%, suppose I don't file only, what happens? Now, if you do not file that, 1 lakh is the only penalty? No, it is not like that. If there is a notice before you file that form 3CEB, you could potentially be subject to not only that 1 lakh but 2% of the transaction values of your transaction. So that could be really big. So do not take chances of saying we will not file form 3CB just to say that this international transactions are just not reported because you have not filed 3CB, so only 1 lakh should apply, but it will not happen like that. So please be wary of this aspect. Just to add here, the institute has issued a guidance note on reporting. It's a very recent one, August 2020, and I have tried to ensure that we take some guidance from that, and some of the guidance is there as we go along, and I've picked it up from the August 2020 guidance. So let's look at what happens, and again, as I said, we need to just refresh ourselves. This is what we talked about was mainly for the Indian companies, but there is definitive application of form 3CB for foreign companies also. So anything that is taxed in the hands of foreign companies also need to report, because the foreign company, being a non-resident, having a transaction with a resident, they are also need to be compliant with the 92E provisions, as we saw that. So what happens? It has to be a mirror 3CB, because it will have a transaction with a domestic company, and the domestic company also will put that in their 3CB, and therefore it will be a mirror 3CB. What happens sometimes is that the foreign company and the Indian company are not done by the same tax professional, and there could be varying amounts, and this could come as a risk factor and get picked up. So we need to ensure that that is a well coordinated effort if there are two professionals involved in the foreign one in the foreign company and one in the domestic company. So please look out for the foreign companies. In fact, in your clients, if you are doing for a domestic company which has got international transactions, always seek the client's understanding to say, are they doing the compliances for 3CB for the foreign company, because they will otherwise get that penalty of 2% that we talked about. So foreign company could then be subject to penalty if that is missed out. Now, what needs to be done, as I said, taxable transactions, so royalty, interest, service fees, etc., what is in the hands of the foreign company will have to be taxed in the hands of the foreign company, and therefore reported as such. There is, the starting point of the foreign company for two things. One is their return that you need to look at, even if you're not doing the return but only doing transfer pricing compliances. So please look at the return and what is being offered as return in the return. Also refer to the 26 AS, because so many foreign companies not only have transactions with their own AE, but they might have with somebody else also, and whether they are they are deemed international transactions, etc. So you might want to just have a look at the 26 AS to ensure that all transactions which are taxable have been captured. Because for the domestic company, you will have the RPT schedule in the financials to look at. For the foreign company, you don't have the RPT schedule because they don't have financials for India. So 26 AS is a good starting point. And I just want to, I'll keep on peppering this whole, session with these kind of things to ensure that, we have a lot of, thought process when we go and do the compliance for this year for our clients. There is one other peculiar issue for foreign companies. There could be exemption of for the return. So for as we all know, we have now royalty, interest, etc. If we have withholdings which are done as per the act and not as per treaty, you may not need to file a return. However, you may still need to do a TP compliance. So that's a peculiar thing. You still need to do a TP compliance because there is no exemption that is given under the Act for the 3CEB. But there is an exemption for the return. Now, how will it happen in terms of, for TP assessments? As we all know, foreign companies also would get picked up for TP assessments, and not necessary that if the Indian company is at arm's length, the foreign company is necessarily at arm's length. We have the judicial precedent in instrumentarium, which shook everyone, from taking those kind of stands. So you have to ensure that foreign company on its own as a tax assessee has its transactions at arm's length and not only the Indian company. So you might have to have some struggle, or you might have a struggle with the foreign companies 3CEB. So please look at that. Just an added one, there is an applicability for permanent establishments also. So if there is a permanent establishment of a foreign company having transactions in India, then it also needs to comply with the 3CB requirement. So with this, let's go to what is 3CB and quickly do a little bit of a refresh, I would say. So, sorry. So the 3CB is divided into two parts. One is the report, which we sign off as the auditor in that sense, and then there are annexures, and the annexures are broken up into three parts. Tax particulars, taxpayers particulars in part A, which is clause 1 to 9, international transactions from 10 to 20, and part C is basically specified domestic transaction. And some other, newly inserted 23, 24, 25. We will come to that, at the end of this. So there are these three parts to the 3CB as such. So as I said, part C has been notified very recently. So we'll touch upon that as well, because that will be a new thing for all of us. So this is the opening, I would say, of the 3CEB, where we have to sign off. And if you look at it, really what we need to do, this is true and correct, and we need to sign off this as true and correct. It is not true and fair. So friends, we have to be very, very vigilant in the reporting, in the numbers, etc. And there is a lot of number work that we have to do as it will come up, and as some of you might already be doing this for a long number of years, from 2002 onwards. This was inserted, and we every year we come up with new issues, new thoughts on how do we kind of comply with some of the aspects of the 3CEB. Just to add one more thought here, for international transactions of lower than 1 crore, you don't need to maintain documentation, which is popularly called as a TP study. But you still need to do the 3CEB, as I mentioned, even if 1 rupee of transaction you have on the international transaction, because some clients always come back and say, if I don't have to prepare documentation, why do I need to do 3CEB? But 3CEB is there for even 1 rupee of international transaction. And for tax practitioners, I would say that please ensure that there is some kind of documentation before you sign off. Because not doing some part of documentation, not looking at some part of documentation, and you signing off on 3CEB might have some repercussion as a tax practitioner, or signing off as a tax practitioner, because what did you look at to form your opinion of true and correct? I think that is something that we may need to be very wary of. So please, now on, we start off our journey to the 3CEB and how it it kind of stacks up. So there is part A, as I mentioned, and it just gives these kind of details: PAN number, address, name, nature of business, and code for nature of activity as per ITR 6. What is the aggregate value of international transaction and aggregate value of SDT? Now, just to mention here, the aggregate value of international transactions is very important, because this is also a determinant for companies to file their master files. So if a company is liable to file the master file and requirements under that, so those forms need to be filed, then this is the buzzword. So what will you put as international transactions is very important. So there are varied views, and just to give you an example, balances in your books, whether they qualify for as international transaction, or is it a result of the international transaction, and whether you will report here or not, is one issue that a lot of people continue to grapple with. To say, if you do that, then you might just be closer to the master file requirement. So, for instance, example, if you have a transaction of say 30 crores, and that is not paid at the end of the year or not received at the end of the year, then you will have a 30 crore of transaction which you report and 30 crore of balance. It totally becomes 60 crores, and that will get over the threshold limit for filing your master file, and that could come into play if you report 60 crores. But if you report 30 crores, it may not. So one has to be very careful when dealing with this aspect. So let's look at the 3CB part B and what it is. So the first one is the list of A's which need to be there, and the relationship between the A and the taxpayer, and the activities in brief. So it need not be extremely descriptive, but descriptive enough. So whether it is a sister concern, whether it is a parent, whether it is a subsidiary of the Indian company. So all of that needs to come in over here in terms of the relationship. And then there are various clauses which are there, and we'll go to each of these clauses. I've just enumerated some of these here to ensure that we have that at one stroke. So some of the definitions, and I think the yellow star that is there, reference can be made to Rule 10A, 10TA for some of these definitions that would be here, to ensure that we stick to that, because otherwise 3CB per se does not give anything, or 10E, which is the rule, does not give out any other definition. So please look at 10TA if you need to. So next is the part C, which is on specified domestic transactions. So it has name, address, PAN of the associated enterprises, nature of relationship, brief description of the business carried out, and the transactions. And what are these transactions? ATI, A8, or 10AA, or the newly inserted 115 BAB, which is which are companies which have a lower tax rate. So within the group, if you have, or within, I would say, the circle of influence, if you have any companies with which you deal with, and which have got a lower tax rate under 115 BAB, then companies which are under the subsection 6, which is akin to the 10 ATIA 10, might have to be reported. Now this is a very tricky one. When we come to that, we will go over some of the aspects of what can you do as a signing chartered accountant or an accountant when you sign off a 3CB for your client, and of course any other STT. So these are part A, B, and C as we look at. Let's look at some of the procedural aspects before moving into some of the some of the clauses. So please register yourself because practicing CAs are required to create their separate user ID online on the website of the government, because otherwise you will not be able to sign off. So this is the first thing. So people who have not yet signed off last year probably might have to do that now. So this is the procedure. You have to register as a tax professional, and the company with which for whom you are doing, they need to add you as a CA for the desired audit report, tax audit report, or 3CB, etc. on and matching their profile in their profile, so that you have registered. There is an acceptance from the taxpayer to say, yes, this is the person who's going to sign off. Unless this is done, on the last day, we've seen some people struggling with it because, they don't know what to do. And this is as simple as just creating this profile of yours and then then the taxpayer approving that. Going to, the filing, it is an electronic filing. So you are expected to upload the 3CEB. And it is similar to the e-filing of returns, so I'm not getting into that, but just to mention that you have to upload. And once the 3CEB is uploaded, it will show up as it appears for the taxpayer in his work list. And somebody in the taxpayer will have to accept or reject. And I would presume that it will be accept. Reject will be in a very, will be a bad case if you have missed out something and you yourself tell the taxpayer or your client basically to reject that report. But otherwise it will generally be acceptance. I've had a case where, and this is important, I have had a case where we uploaded the 3CB and the client went home. And his digital signature was in a drawer, and he just left. Now we were on the last day at about 11 p.m. at night, and waiting for him to accept. And when we called him and we said, you've not accepted, it's not complete as yet. And he said, I thought you uploaded and that's the end of it. And we had to tell him that, go to office, please open and then accept that. So this is something that we need to be very wary of. The next one is notes to 3CB. There is no provision. There is something that we can add as part of the attachments. In the utility, at least it used to be there. The new utility has not come, by the way. So the form has come, but the new utility has not come. It is still the old utility. So that may not work if you have transactions in the clause 24 or something like that. Then the old utility may not work. So we are all awaiting also the CBDT issuing the new utility. But I think the problem is that you might want to put some notes. For instance, you have taken a stand for some of the transactions. So what do? The practical way, whilst this is there, we've seen that it is not happening. The note cannot be attached. In fact, the guidance note also for August 2020, and we thought they might the institute might have put something, but they have also said that the attachment is not happening. So you might have to actually ensure that a physical copy of the notes that you put up should be filed with the tax authorities, and you get a copy back of the filed notes. It will protect you as a tax professional to say that you filed along with some of the notes which you felt are important. It will also protect the taxpayer. So please ensure that you tell your clients that it is in favor of both of you to do this, and it can be filed after the 3CB is uploaded and accepted. In the next 5-10 days, you should go ahead and file the notes. And I would urge everyone to do that. As practicing chartered accountant, we all know that nothing can be unqualified in a sense. Everything has a assumption, and those assumptions we put as notes. Qualification is too bad probably in a 3CEB, and probably clients may not accept, but a note might be very well accepted, but you just ensure that it is filed also. So going to the next one, okay, yeah. There is no provision to revise a 3CEB. Practically, we have seen in few cases where revision has been possible. So revision is possible, at least on the portal, it is possible. In fact, we've seen revision happening even at the end of the TPO, when the TPO has figured out something or has asked to change, etc. And they have also asked for 3CBs if there is some error in the 3CB. But I would urge that please relook at whatever work you have done, and if you find in the course of the work done for maybe next year or in the course of the year that you find that there was some error in the 3CB, please go ahead and revise the 3CB. It can be done online. Somewhat one needs to, of course, give a reason for revising the form, and you can be as truthful of saying that this was missed out, it was not there, it was revealed later, whatever the cause may be. And it's always a difficult thing for us to say that a true and correct picture that we gave and signed off needs to be revised. So but it's always good to do that. Accepting your mistake is better than somebody else picking up your mistake and putting you in the dock. So just to get to the utility has to be filled in. So it is not something that you can import, and so it cannot be taken up from the Excel or Word, but you have to fill it up online and then upload as an Excel. So that's one. The other is there are 6 methods, as we all know. The last one is other method, and you need to put a method for each of the transactions. If you do not, it will keep on throwing an error. So at least put other method if you're not sure, or if you have not come to a resolution by the due date. I'm sure we all follow good practices, and we will have a strong basis of choosing the method. But in case something is not sure, please write other method, otherwise it will not get uploaded. So these are some of the practical aspects and procedural aspects, and I'm sure there will be questions on this, and we will come to that in a while. So let's now look at what are the key issues and go through the clauses in that. Just one I would say advisory from my side. Look at various things. Do not only rely on the RPT in the financials. So if there is another auditor who has signed off the related party transactions annexure for in the financials, because the Companies Act has a slightly different definition of what they need to present, and for the 3CB and several of these clauses, you might have to have a different set, or at least some of the other transactions also, which are not necessarily reported in the RPT. So, so just for example, transactions which are very nominal may not be reported because the Companies Act doesn't enforce that on the auditor, on the statutory auditor, and that's perfectly fine for the audit. But for the 3CEB, you need to report each and every transaction because it has to be true and correct, as I mentioned. So please ensure that one does that. Look at the financials, the books. Also look at other records. So, for instance, the records of the company secretarial records, which have transactions with related parties. So you might want to rely on that. So you might want to just go back and look at those records to ensure that you are not missing out anything. So even if the related party transactions annexure is not absolutely up to date, there is no penalty for the statutory auditor, because the statutory auditor generally will say that, this is as reported by the company. You may not have the ability to do that when you sign off a 3C. So that's piece of practical advice. Let's go to now the clauses, and as I said, um, clause 10 is more of listing of all your A's. So that's only a list and the transaction and what relationship you have, etc. Clause 11 is from where you start off your transactions, and they're now spread across. And we'll go through each and every clause. Most of the clauses I have put on the screen itself so that we know, and if there is any question, please, as I said, post it on the chat box, which will be showing up, and we will try to. My colleague will try to respond as it is. I think he has probably started doing that on the chat box. So this is on tangible property, and every clause has a purpose and a meaning, and I'll just ensure that I put good emphasis on that. So clause 11 is broken up into clause A, B, and C, and we'll come to A and B, which are for tangible property. And for the tangible property also, clause 11A is purchase or sale of raw material or consumable for further manufacturing and processing. Clause B is purchase of sale of traded goods, traded or finished goods. Now, we need to ensure that these are two different things. One is for sale of raw material or consumable. One is for sale of traded or finished goods. I have seen a lot of professional firms not making that right distinction, and making a mistake in reporting a transaction, and that lands up into a little bit of a problem at the TPO's end when you go for a TP assessment. So please ensure that you have the right clause in which you report. And what do you need to report? And this is general, so I'll just take this moment for this clause, and I think the balance clauses will go a little quicker. So first you have to say whether you have transactions, and if you have, then what is the name and address of the associated enterprise. Then you have to put a description of the transaction and quantity purchase sold. This is another peculiar thing. We'll come to that in a bit. And then you have to add what is the total amount paid or received as per books and as computed by the SSE, having regard to the arm's length price. So any difference here could have a implication for the taxpayer in terms of offering the income in the return. So we need to be very careful that as per books of accounts and as per the arm's length are equal or same, because otherwise there could be a challenge for the taxpayer. And then you have to put the method of how you have determined this. And this is same for the for other clauses as well. So it's the same kind of description. There are a couple of clauses where there is some slightly different disclosure that you have to make, and we'll come to that. But otherwise, generally, it is name, address of the A, description of the transaction, what you have done, what is paid, received as per books, what is as per the arm's length, and then what you have done as a method. Let's look at clause 11C, which is the last clause for 11. So this is also tangible property, but this is for the purchase, sale, transfer, or use of any tangible property, and this could be slightly different than the first two. As I mentioned, the first two are for raw materials. The second is for traded goods or finished product, and this is probably for the capital goods or fixed assets like building, vehicle. Building, you may not have an international transaction, of course, but you may have vehicles or machinery. Building, you could have, if there is a PE in India and then it is selling to the local entity. So you could have, of course, building also, but so indicatively these are reported in 11C. So do not mix up all these kind of transactions. These are so 11C is basically what comes directly in your assets. 11A and B are something which will go to your P&L. I think I kind of think about it a little like this for my own comfort purposes. So let's look at what are the examples 11 and what needs to be done on this clause. So quantitative details, as I mentioned, there is some bit of discussion that is required. You may be buying raw materials, and let's say something is like a consumable oil. Some items are hard items like nuts and bolts, and some items are big things, like a plant itself, or one item which could be very large. Now, quantity of each of them may need to be reported. So either you report separately, which becomes a little tedious, or you may just want to mention various to ensure that you are mentioning that, and you have a backup of it at your end, because liters and kgs and numbers or unit numbers could be very challenging to report in that one form. And so same goes across. So fixed assets also, you could have many computers, for instance, and then there could be a plant or a fixed asset that you could buy. So it could be number which could be different. What you need to do, check the value, quantitative details from notes to accounts, accounting standard as per AS 18, invoices, ledger accounts. I think there are a lot of these things that you may need to look at. As I said, you could also look at some of the secretarial records. You could also refer to customs valuations, notes and notes to accounts disclosing foreign exchange outflow if there is import, and group pricing policy. One could also look at the master file also of the group. If the excess of master file is available, please look at those also, because then you could have a much better understanding of how the group is behaving and what it does in terms of transactions. For 11C, as I said, which is like a balance sheet item, you could look at fixed asset schedule. You could have what are manufactured by the A's and sold to you. Back-to-back invoicing if it is for third party. You could look at customs valuation if it is brought into India and customs duty is paid. You could look at independent valuation report, chartered engineers, for instance, to figure out what is the arm's length value for and what is the value at which it has been bought. There is always a challenge when you import anything, either 11A, B, or C. Customs value could be different and income tax values could be different, and you could actually have a much bigger challenge when you have to determine the arm's length as per the Income Tax Act. So those challenges are there, and I'm not getting into the benchmarking aspects here because that's not really relevant for this today's discussion. But just to let you know that you will have to overcome that challenge. If you are doing the documentation, then you will have to look at all these to determine whether it is at arm's length or not. What do you do as benchmark? You could have any of these methods for 11A and 11B, because there could be a combination. So if you are buying a work in progress, something from the A, it could be a gross margin that the A is making. If you make the A as what we call as the tested party and are looking at the profitability of the overseas entity, or you could have if you are selling goods, you could have either a cost plus at your end or a TNM. Friends, here just to add here, I have always seen that people make mistakes in the cost plus and the TNM. Cost plus is something that you would do for various things which are not your finished products, either work in progress product or something that you would want to do at the gross level. So it's a gross margin. While you may say it is a cost plus method, it is generally at the gross level. Just to, thumb rule, I would say. There could be some situations, but we're not getting into those. And transactional net margin method is generally what we call as the operating margin for a particular transaction at the net level, which is obviously a profit before taxes, but it's at the net level, removing all the non-operating items on the income side as well as the expense side. So please look at this carefully, so that when you determine the method, you are careful, you're right, and not make a mistake there. For fixed assets, CUP or other methods are good enough, because other methods you could have used either a customs duty valuation or a chartered engineer certificate in either cases. Just to add here, this could be also important for assessing whether, some people ask me whether a WDV is good enough. WDV is not good enough, unfortunately. I would say the worst choice that you can make, and the last choice, I would say. If nothing else is available, then you might want to go and fall back on the WDV, but otherwise always insist on a valuation report, or at least a chartered engineer's or somebody else's report. So other issues on this one is sale of raw materials not utilized for processing manufacturing. An institute has given a guidance on all the clauses actually, but please look at 11A specifically. I mentioned about the lack of availability of quantitative details. Again, the practical situation and the guidance that institute has also given is that you could mention numerous and keep the backup at your end. So these are practical things. The yellow boxes are really, what you need to do. So whether you will include foreign exchange loss, which is capitalized on imported goods or software. Software, of course, is out of this clause. It will go to the next clause, and we'll come to that in a minute. But imported goods. Now, what happens to foreign exchange loss? Will you if you have capitalized, will you report that or not? Is one question that you need to deal with, because truly, is it a transaction, or is it a result of a transaction? Is something that you may need to look at closely. There could be also, acquiring of technical know-how from A, which is capitalized in the books of account, but this is not the right clause to report that, and it has to go in a subsequent clause, which we will come to again. I just thought, I will mention these because I have seen a lot of places where 11C is used to dump all of these things, and I wanted to ensure that software, and of course software always has a challenge, because whether it is goods or intangible is always a challenge. For us, it will always be mentioned in the other clause and not here. Now, I already dealt with this question. WDV in books can be considered. To my mind, it should not be. It should be the last resort. But you may want to take your own call. I'm not here to kind of tell you what to do. I think you all know, you all very experienced. In fact, more experienced than me. Also, some of you have joined it. So I will not delve on these topics as to what calls, but I would definitely like to draw attention to some clauses where a bit of thinking is required. And of course, if you require any help in doing that, please do connect up, put on the chat box, and try to answer that as we go. And the plan is that we will leave some time at the end to address some of the questions. So, friends, coming to clause 12, this deals with intangible property. And as I mentioned, this is more or less similar, so I'm not getting into the actual clause. But what it includes trademarks, trade names, brand names, logos, patents. I put all that, copyright, software, trade secrets, customer lists, one important thing is organized workforce. I mean, we've seen now this happening a lot in the space where software companies are or companies being acquired, and there is a workforce which has got some level of understanding of the company's operations and are a very important intangible property. So we need to probably put this over here. Whether you paid that or not is something of a debate, and whether you should pay for it or receive something for it is something that one may need to look at separately. So anything that derives value from intellectual content has to be put in over here. And there is a very wide definition which has been given in 92B2. So please again take your call to say what is intangible property. I would also pause here and say that sometimes intangible property passes on without a transaction value. And that is true for many other services which will come also, but let me just address it over here itself. You may also need to look at, and which I forgot about it, please look at what has happened for GST. So, GST has, under the GST regime now, things which have not been charged also has to be valued, and GST has to be paid on that. And whether that impacts any of these clauses here on needs to be evaluated. So if you have paid GST and there is a value to it, have you missed out on a value? Or for example, if there is a cost plus entity, and in the cost base some services which have been rendered by the overseas entity has not been reported and has not been charged also fully, but if it has been in the GST returns, it has been offered to tax and on a recharge basis. What happens for the purpose of income tax? So you might have to actually report that because you have undermined the cost base of the Indian entity. So please take a good look at some of these aspects also, and I just want to leave that thought with you. It is relevant for many other clauses that come up also, especially for the services clause. So let's look at what needs to be done. So any purchase, sale, transfer, lease, use of intangible property, you have to use this clause. For documentation, look at the agreements, computation, withholding tax certificates, I would say GST returns, etc. So if it has been paid on a reverse charge mechanism, please look at that and don't miss out on that. Look at the past and ongoing litigation history for transactions which have been identified in the past by a TPO, let's say, for example. Please go ahead and see and take your own comfort whether it should be, not because just that the TPO has identified and has been pushing the taxpayer, you need to report, but if you believe that this need to be reported, you report, or you put it in the notes to say that, in the past this has come up for TP, but we believe that it is not a transaction. So, but take a view on these things, and I would say document it. It's always good for us to document it before we sign. Again, as I mentioned, master file also needs to be looked at because these will throw good light on the intangibles and off balance sheet intangible property. You will also you'll be able to understand and figure out within the group who has owned the intangible property and who has given the intangible property for that matter. So that's also very important. Look at for the benchmarking purposes, whether it is cup. Of course, it will be very difficult, but we have found in cases where intangible property is used by the Indian entity, and there are third parties to which the same intangible property has been given by the group company, and there could be cup situation. So do not discard any method. I think you have to what one needs to do is actually look at all the methods for each of the transactions and then discard one by one and figure out which is the most appropriate. And that is why what is written in our act is most appropriate. There could be in situations that we've seen where you have to make a judgment call to say which is the most appropriate, because there could be two methods which could apply in the same case, but you'll have to make a choice of saying which is the most appropriate method. So one has to be very careful on this. There could be another one, and this intangible property, and this new aspect under the litigation is whether advertising, marketing, and promotion expenses, and whether this is an intangible, and whether it has to be, reported under this clause. Now, there is first question that we need to deal with is whether there is a AMP situation in your client. And this is a judgment call. No client of yours will say that, there is a transaction like this. So one has to first determine that. And that is where it is the most difficult, whether it is under this clause or not. First of all, you have to make a determination of AMP. Now, that itself is going to be a challenge. Now, what needs to be done for existing agreement or arrangement for the intangible property, but which is not charged to the AMP? So there could be agreements and it is not charged. Let's say a moratorium is there for 3 years or 4 years till the SSE or your client starts making profits. And we have seen a lot of these arrangements also. So you have to make a judgment call. For instance, if it is a cost plus entity, you might want to actually add that, because otherwise, and at least see whether they still meet the arm's length, even including that. Because if there is an existing arrangement, it has just not been charged. It might be that for the reverse charge mechanism to kick in for GST, it might have been reported there. It could be very well that they might not charge for a few years, and that could be as per the agreement itself. And can you then bring in the theory of real income, for example, to say that real income, there is no real income in the hands of foreign income, and therefore there is no in the foreign company, and therefore there is no real in expense in my hands, and therefore I need not disclose that. Or I may just go to the notes and say there is an agreement like this, there is no charge for this year as per the agreement, and hence no transaction reported. Or should you just mention that and say 0 transactions, a nil, and as per arm's length also nil? But one needs to look at the agreement, the clauses, and figure out what's the right thing to do. Proprietary computer software, with charge or without charge. Even if it is with charge, of course, you will report it, I'm sure. But without charge is something that you may need to make a judgment call again, and whether you need to disclose. So you need to get into the client's business to figure out this aspect, because nobody will otherwise look at the financials and figure out whether there is a proprietary computer software which is in use. And one could, for instance, an example, say that if you are a cost plus or a services entity, no risk service entity, and you are only serving the parent, then they are giving you a proprietary computer software to work on. It is basically the tools of trade. I need not pay anything anyway. So I need not report also, because that is wrong to infer addition to my cost base, because this computer software is given to me to perform these services, and it is not something which is off the shelf, which I need to perform services. So for example, if I have a Microsoft license for Word, etc., and my work is to use Word and then send it back to my EE, that is definitely has to be in my cost base. But a proprietary computer software which enables me to say log in into the cloud and use the software to give my services may not be chargeable. So one has to make that distinction, and that's why some of these questions are questions and I don't have an answer, because you may have a practical situation at your end which may be different than another person. On the AMP, we talked about the advertising, marketing, promotion. There are some case laws which I have put on this slide just to ensure that we cover everything. and the real income also that I talked about. So I'll not delve into it, but if you have questions, please post it, and we'll try and respond as much on as we go along, and we'll take up some of the questions which are not being answered or which Abhishek has left for me. I will I will take it up at the end. So let's look at the next clause, which is services. Some of the services I have mentioned here because just that the definition says these are the kind of services that could be there. But a large number of clients, especially in Pune, Bangalore, Hyderabad, that people have joined in. The software services of companies, subsidiaries of multinationals which are there, could have this clause as the most important clause to report of serving. But there could be these other things also. So market research, market development, market management, administration, repairs, design, consultation. So many are there, and I've just listed down to ensure that beyond the software services also, one needs to look at whether if these services are rendered. There is also a reason why I mentioned here, because some of the services you need to look at to ensure that when we come to the clause of deemed international transactions, these could be important. So example being given is, let's say, consultation or repairs or agency, etc. And if there is a deemed international transaction where the global entity has agreed upon the fees of a third party to serve you, or for you to render services to the third party, but essentially the terms and conditions are agreed by them, then these services will go into that clause, and it will have to be reported, though you are serving or you are receiving services from a third party. We'll come to that when we come to that clause, but I just thought I will mention that. So disclosure is for the services rendered or availed. What we will look at: agreements, invoice copies, debit notes, A versus non-A profitability, when either the taxpayer for whom you're signing off has the same services being rendered to a A and to a non-A, both, then you could have a situation where you will have what we call as an internal comparability of the TNM. You could also have the A serving you and the A giving the same services to a non-A, and you could have an internal TNMM at the end of the A, and you could have a tested party as the foreign company A. So a lot of these combinations keep on happening. It's a vast subject, so I can't go into details of each and every one, but if you have specific, as I said, please keep on writing. Working and basis of such segmental profitability, you don't have to submit it here in the 3CEB, but it's very important for you to keep it as part of your working papers. We've seen in statutory audits and some of the cases where auditors have been asked by peer reviews in the peer reviews to say, please bring your working papers. And I'm sure some of these aspects will come in even in other certifications, including this 3CEB. So please keep these papers with you. Allocation keys, whether you're satisfied with the allocation key, for example, if there is a internal TNMM that has been done or a segmentation that has been used, and services is one component, and others are manufacturing. So and most of the companies in manufacturing are into this kind of multiple things. So there could be a segment which is only manufacturing, some could be only services, some could be marketing commission, and the allocation that has happened for the items of expenses needs to be looked at to assure yourself that what has been done. Allocation is not something that is your responsibility. It is the management's responsibility to provide you that allocation, but you need to be assured that the allocation is is overall well done. It has a basis on which it has been done. The benchmarking could be anything. It could be CUP, it could be cost plus method, or it could be TNMM. And I have written some of the methods just to ensure that we have I would say some indication for each of these clauses. Not necessary. You could also have others in this in some typical examples. So I'll leave it at that. So for instance, brokerage example. Brokerage could be other method because it is driven by SEBI, let's say, and you are doing for your group company. So in financial services, you have the Indian company, which is doing brokerage for the Indian bank. I have not named, but I'm sure some of them are my clients as well. So they could have other methods as an indicative method for the benchmarking, because this is pretty much mandated by SEBI, and you cannot go over that limit. So so TPO cannot say that you should have charged more with your AE because they made a lot of profit, but that is just a transaction that you carried on the exchange or any other forum. So what are the issues? There are issues in terms of services, whether it goes in clause 13, 17 or 19. We'll come to 17 and 19 post this, but just to put that issue right here, there could be the determination of the method, which could be applicable, cost plus or TNMM. And as I said, there is I see a common issue, people writing cost plus method in ITES, which is a wrong definition. Please use TNMM because you are actually using the net profit and not a cost plus. Cost plus is generally used in a manufacturing setup. So please do not use cost plus unless you are doing a service which is slightly different. I have indicated this in the benchmarking here, but these are for others, and for ITES or a BPO, KPO kind of thing, then TNMM is the better method because you are using a net margin method. The last point on this one could be disclosure of other services not included, which could be a BPO, KPO, IT support, engineering services, etc. As I mentioned, all of these will come in clause 13. And many of you are well versed with this clause, and probably the most used clause in and around Pune, Hyderabad and Bangalore, as I said, also could be. There are other aspects which we have put in the yellow cloud, reimbursement with administrative markup. Is that service? And this is a difficult one, whether reimbursement with the administrative markup, is it a service? It may or may not be. You can say that reimbursement is not a complete reimbursement. There are other costs also attached to it, which we cannot look at, and therefore there is a markup attached to it. So you would have to make a judgment call here again. You may also want to look at whether there was a withholding that has happened on this, and then take a call on whether it is a service or it is a reimbursement. There could be charge for salary of expats. So a lot of expats are there, and there could be a charge which is there for coming from outside. It could be just a recharge for those fees for reimbursement, like because the expat is paid outside India and they are just charging you for that salary. Now, will it be fees for technical services, or will it be just your own expense? And you may need to report, but not at least under this clause. May again need to be looked at from various aspects, including the TDS aspects. Just give me a second, please. Sorry. And again, as I mentioned, services rendered without charge or free of charge, but considered for GST is something that you may need to look at and report if the facts so tell. Moving on from the services aspect, let's go to the next clause, which is capital financing. Now, this is for all sorts of financing. Now here, the clause is slightly different. So I will just draw your attention to all of these. There is what is the nature of financing agreement, what is the currency in which it is happening, the interest charge paid or received, and then of course these clauses are same. So there is slightly difference over here. Uh, the issues could be short, medium-term loans, working capitals, or arrangements, etc. Could come here. Long-term loans also, non-convertible preference shares, debentures, ECBs. So anything which is capital financing will come in this clause. There is trade advances and receivables. By this amendment, this also should fall under the capital financing. Now, there is always this question of saying, whether my balances which are left out, are they trade advances and receivables? I would tend to say no, because these are not real. These are, as I said, it is end result of a transaction and not the transaction itself. So I would not really want them to be reported here. Otherwise, you will have to, as I mentioned, get into the total international transaction, and it could be a challenge if you have to comply with master file, etc. But a trade advance which is given as an advance and that is the transaction, then you may need to still put that as a transaction. So take your call again, as I mentioned. Some of the aspects of these, review the agreements, borrowing terms, currency of loan, determine the source of funding. Again, here there could be a challenge in terms of what is the tenure, whether there is a moratorium, and whether that moratorium should be in that moratorium should you disclose the amount or not. And there could be challenges for the foreign company also. So if the foreign company has given financing to the Indian entity, then that could be a challenge. If the Indian company is the group parent and has financed, that also need to be put in over here. And if there is a moratorium, then there could be an issue of saying, why the moratorium was given in the first place, etc. And have you made good enough interest for the period of the lending? And I think that could be a term test, as we call that, could come into play. I've put some questions here, and I'm just going to run a little bit faster because I don't want to get into each question. But some of these are, I give just 20 seconds for you all to read this and just ensure that these some of these questions, when they come in your clients, please pause and think. Do not just accept what the client is giving you. As tax professionals, and as you read, I can just keep on speaking. As tax professionals, I do a lot of TP studies, and sometimes some other chartered accountant is signing off, and I always ensure that my team or I give them the right understanding. Especially keep that all in the TP study and give it to the person who's signing off, because that person needs to understand what is the essential transaction and what are the aspects related to these things. If you have any questions, do kind of fire in these questions. Sorry, I don't know, something happened to this. Okay, maybe let's just go to the next one. So the next one is on guarantee. Now there could be guarantees which could be many aspects. I just quickly go through because this is also slightly different. So name and address, nature of guarantee agreement, currency in which guarantee is given, and compensation which has been given. Now, as you know, this guarantee which has been there is lending or guarantee, and then the whole definition which is there is given to mean that it should be a financing. But there could be, in some cases, what is called an implicit guarantee or explicit guarantee also, but for performance. Now, unfortunately or fortunately or whatever, this is not covered under this 3CEB at this point in time. So what you are looking at is only aspects of of guarantee which are in the financing arena, and not really the performance guarantees. But of course, if you have paid for a performance guarantee, then probably you still have to put that over here. So, or received, of course, for performance guarantee, then also you have to mention it over here. Let's go to the next one. So again, disclosure, explicit corporate guarantees for financing transactions need to be reported. Identify, so documentation that you will use, you will have to use the contingent liability aspect, because if it is possible to be payable, then you will pick that up. So if you are an Indian, if you are looking at the Indian client and then it has given a guarantee for its subsidiary, it may come up in the contingent liability. So you may be able to pick up from there. RPT schedule, of course, and then determine the nature of the facility or arrangement. There could be only a representation letter, and actually it may not be a proper guarantee. It may just be a letter of assurance, for instance. And there, there is no expense or income from that kind of thing, and there may not be a reporting requirement also. So please look at all these. Disclosure for letter of comfort, performance guarantee, something you may need to look at. As I said, performance guarantee, possibly if you are paying or receiving, then you may need to, but otherwise performance guarantee not written explicitly in the clause. So guarantee amount disclosure every year or in the year in which it is issued. That's another question. I think it has to be done every year as long as the guarantee is subsisting, because that transaction is not going out and you are standing that guarantee for that year also. So it has to be there. If no guarantee fees charged, what to do and what is the method? You may need to determine the method, of course, but and look at, for instance, as I said, look at GST. And the interplay of GST has become such a big influence on transfer pricing also now, that it can no longer be avoided for us. So please look at that and see if there is a value that has been put up over there, or if the guarantee itself is such that you don't need to pay or receive, because it is not a guarantee in essence, but it is only a comfort letter that has been given. The other question, and a very great question, is whether it can be treated as a shareholding activity and no charges required. Because TPO also, what they typically do is, as you are all aware, if you are an Indian company and giving a guarantee to a shareholder, then they will say you should get that money, and it should be at, let's say, 2%, 3%, whatever. But if you are an Indian subsidiary and the foreign company has given you a guarantee and you are going to pay, they'll say, no, this is a shareholding activity. Why you should pay? Why should you pay only? So important that you also look at it very carefully, whether it is charged, not charged, whether it requires a charge or doesn't require a charge. You can look at quotations from banks to justify the charge if some of these financial guarantees are also. And we looked at some of the cases where there is some website which actually gives out what will a bank charge as guarantee for some of the financial transactions. So look at some of the important judicial precedents of so Bharti is one where it said there is no international transaction. So Bharti obviously is an Indian company, gave guarantee to its subsidiary in Africa, I think, if I'm not mistaken, and then they said that it is not an international transaction. It was a shareholder activity, and therefore it need not have charged, and that was upheld. So some of these, again, Tega was a similar thing, whilst Everest was where it capped at 0.5%. And there are many other case laws. I'm not going through case laws here, but just ensure that you are doing the right thing. Okay, the last one is, please ensure that you put it as notes. Disclosure is mandatory, and this could be very, very big numbers over here, and therefore let's not shy away from reporting either here in the clause or in the notes. Moving on to clause 16, which is marketable security, equity shares, OCDs, CCDs, or convertible preference shares. Here, there is a lot of confusion. I will go through it a little quicker. This one is pretty much similar to what we have for guarantee. Currency has to be there, and consideration charged, paid, and then method used. But important are these aspects. Whether issue or allotment of equity shares need to be reported, and to my mind, and rightly, adjudicated in Vodafone, that since this does not result into a taxable transaction, it need not be reported. The guidance note, however, says, and it actually says, out of abundant caution, you may disclose. The guidance note also does not really say that it is to be disclosed, but it says you may want to disclose. So when it says that, I would say you put it in the notes. Do not put in the 3CB form in the clause 16, but put it in the notes to say there was an issue of shares or allotment of shares. Sale of equity shares. So if you sell equity shares, there could be buybacks, etc., which could be there, and whether that should be reported here is something that could be a question. If you sell shares of a subsidiary to a foreign company, or similarly, a foreign company sells shares of another subsidiary to you, yes, it has to be reported over here. Appropriate benchmarking has to be there, and we've seen various aspects coming in when these kind of things happen. There could be a value which could be a kind of handshake value. There could be a value which is as per the net asset value, and there could be sort of rather 11 UA value or whatever, and there could be a DCF value, and all these three could be different. And then you will have to figure out what is the appropriate benchmarking for this value, and this is kind of a difficult choice to make. Issue or redemption or conversion of optionally convertible debenture. There's no optionally convertible. There is only compulsory convertible debenture under FEMA now. You cannot have an optional convertible debentures, but if you have, or if you want to convert, so the conversion is possible. You can actually repay back the compulsory convertible debentures also. So you may want to, at that point, it requires the disclosure, and appropriate benchmarking has to be used. The question here could be that when you pay return on the debentures, or for that matter ECBs, etc., whether benchmarking is to be done every year or at the time of the issue. To my own mind, it is only at the time of issue, and you can use that every year because your terms are not going to change. So unless your terms are floating terms, floating rate as we call that popularly, then you may need to do it every year. But otherwise, you should do only for 1 year at the time of issue, and you should carry it forward every year till the loan agreement does not change or terms do not change. And there could be a different view for a lot of people I've seen doing benchmarking every year. Not required, because you do not have the ability to change it. So what will you do with a change benchmarking? So that's the point. Let's look at clause 17, cost allotment or apportionment. Again, these filling to be done in the form are pretty straightforward. I'm not getting into that again. But this could be like intra-group services, or not services, I would say, in the nature of management charges or cost allocation within group company. So central functions or shared services as they call. And if that shared services are allocated, then it should be the right clause to report over here. And as we saw in clause 13, some of these are actually cost allocations and not service elements. And therefore you may want to treat it or put it over here. So let's look at what you need to do. You may need to pass the benefit test first of all. So whether these allocations should be taken up by the Indian entity, And I'm just taking that example as an Indian entity because I think if it's a foreign entity to which you are charging, income tax department will have no problem. So we'll stick to this for the moment as an Indian entity. Whether it should have paid is something that's the first thing, and whether it got appropriate value out of it is the next thing that you need to do. The second is whether, and you should pass this threshold of whether it was a shareholder activity. So if there is a PR at work at the head office, and whether if it is charged, whether it is to be charged or not. I mean, it's a global thing, right? I mean, it could be a shareholding activity, or for that matter, they are doing an internal audit. Let's say the group is doing an internal audit, and they charge you for that. Whether it should be chargeable or not, because it is for their own satisfaction as a shareholder that they are doing that, and not for any other reason. I've given a lot of examples here, but I'm just giving something else also to say if an internal audit is done by the group, it should typically not be charged unless you are substituting if you are substituting that for the internal audit that you would have to do as per the law in India, and you would say that that internal audit is good enough. So you are actually saying that my internal audit is being done by X, and as any other internal audit would charge me, they were charging me. That could perhaps be the right way to report. And third is, of course, please put a robust documentation around it. I would say that, for the signing of 3CEB and every clause I've been mentioning, documentation, documentation, documentation. Only three things, and all are documentation. Everything is revolving around documentation and for your comfort. So verify working, get the allocation keys verified, assure yourself, and keep that on your record. The other one you must always tell your clients is the newly inserted 271 AD for any false entry, and it will have a implication in terms of a penalty. So please ensure that if it is not chargeable, you tell the client to offer it as income rather than try and do this. And these are very, very difficult choices to make. And you may have to deal with the client and make your understanding probably more robust to ensure that. So shareholder activity you should not. So I have covered that. Just seeing how I'm doing as time. I think we're going slightly slower, so I might pick up the pace. And if Sachin, if you allow, I might just go, a 20-minute overrun, I would say, if it's okay. Because I would really want to ensure that, in this season, we impart as much knowledge as we can whilst going through this. So cost contribution arrangements are there, and then, there are various things which you may want to address. Cost contribution arrangements are probably slightly different than your normal allocation. It is where everybody puts together efforts and then they are charged as per their own benefit. So those are slightly different than cost allocation or apportionment analysis. Hence, we thought we will just put that on the screen for everybody's understanding. Charge for IT usage, including reimbursement of software licenses, as we also mentioned there in the other clause. What do we do with that? Whether you should report it here or as services under clause 13. And allocation of indirect expenses without markup, and whether it is an apportionment or it becomes services, just because the Indian entity might actually want to withhold taxes, just to ensure that there is no other implication either on the TDS side or the non-deduction that a corporate tax officer might do, and therefore you might just want to withhold tax, but you may still want to say that this is a reimbursement. And the foreign company may want to file a return to say that this is a refund that they are entitled to. So you may want to just look at what is happening at both ends to get to the right clause of whether it is an allocation, an apportionment, or the service that is being rendered. This is a very interesting clause inserted, when the business restructuring or reorganization clause was inserted, um, and slightly different again, name and address, nature of transaction. So nature of transaction, so you'll have to be a little bit more descriptive, we'll come to that in a minute. Uh, and the agreement in relation to such business. So what is the agreement and terms of business? So this is all descriptive here. So it is not as we saw in the other clauses, that this needs to be there. Now, this has to be reported irrespective of whether there is a profit, income, losses, or assets. So other clauses we saw, only if profits are there, or it disturbs your profit, you might want to report, as we discussed. But here it is even beyond that. So you just have to report whether there has been a business restructuring or reorganization. And let me come to some of these other aspects of business restructuring. Now, friends, there could be restructuring of the business or the restructuring of the entity. And these are two different things, and we just wanted to give you examples. So conversion of a full-fledged manufacturer into a contract manufacturer. So there is nothing happening to the entity, but it is giving up probably some of its profitable activities of a full-fledged manufacturer, and is settling for a contract manufacturer with a fixed markup. This is a business reorganization, and typically could be looked at to be reported over here. There could be another for a trader to say, full-fledged distributor to a low-risk distributor. That could be another one. For an entity restructuring, merger of two entities to form a single entity could be another one to report, because this is an entity structuring, not a business restructuring, but the entity restructuring or reorganization, as I would like to put it. So this also will need to be put into play. So I think documentation, look at agreements, look at if there is exit charge payable either in India or out or abroad. If you have done for something for a foreign company, or looked at the foreign company, then please do that. What is the cost benefit analysis? Is there a good way in which you can just whether the company has justified to you to say that my full-fledged manufacturer, I also had losses, profits. It was a roller coaster ride, and I may not have had the best of years in the past, and therefore as a contract manufacturer I will at least have a continuous markup, maybe a smaller markup, but a continuous markup, and I will always be in profit, and that could be a good way. Look at the profitability of the A before and after restructuring. That could be another way to look at whether this needs to be determined as at arm's length or not. A very difficult one to say that this is at arm's length or not, because if you have to make, it's a judgmental call, I would say, to say that this was looked at by you. This will generally be in the earlier slide when you were putting, it will generally be other method, because there cannot be a fixed method to figure out the method. So there could be again issues on between two non-residents, whether disclosure is required, if there is an indirect transfer provisions applicable, and therefore indirect transfer provisions getting into taxability, then do we need to put it? Yes, you may need to put it if it's an indirect transfer which is getting triggered, and what happens with duplication with other clauses, etc., because you will also report some of the transactions in the other clauses after the reorganization, for example. So many things to look at in this clause. One of the most difficult ones, but it will be once in a while. You may not have to deal with every year. It may be very, very occasional that you may have to deal with, and in very few clients. Let's look at the other one, clause 19, and not too much here. I think it is just other international transactions, and let's look at what is other international transactions. So anything that is not covered in the other earlier ones and which has got a impact on the profits or income or losses or assets. So what could be those? It could be cost reimbursement, recovery expenses. Do not confuse it with the other one where it is cost allocation. So cost allocation is separate and cost reimbursement is separate. So any third party transactions, for example, somebody from the foreign company came here and you had to entertain that guest, book tickets for that guest or book hotels for that guest. And then you will charge your A because it's a foreign guest and you have recharged that on cost basis. It will come in clause 19 and not come in the clause 17. So that one needs to remember. So this is, and same will go with the recovery where there is no markup. And you should not essentially have a markup. For instance, your employee goes abroad and has entertainment done at that end, or for instance, costs picked up by the foreign entity, then you will only do a cost reimbursement. So you will reimburse or recover as the case may be. So just look at, so there may not be any agreement as such, but there some cases we have seen agreements, general agreements on this aspect. But verify definitely intercompany back-to-back invoices. Look at those. Some of the challenges that come up here are language problems. So if you have somebody who has gone to Japan and has stayed in a hotel and the foreign company has incurred that expense and charges you back. It will be in Japanese. The invoice will be in Japanese, and it will be difficult for you to actually figure out what is mentioned. You may want to either do a Google Translate to just understand that you are doing the right thing and putting it in the right clause, or you may want the client to to write it in black and white to say what the backup involves. So there are some practical approaches, and we've kind of mentioned some of these over here. Free of cost services or goods. What do you write? What do you mention about that? And that's again a judgmental call to say free of cost services or goods, whether it has to come here or in any other clauses. So if it is cost of services, we would report in 13 because it is still services and it has come as free. But it could be an important one if it is GST and there is a value, then you may say it is not at arm's length because it has not been charged, for example. Dividend paid and received, I believe that it should not form part of international transaction. It should be international transaction, but you may want to report it here because it is not you don't have to really make a judgmental call whether it is at arm's length or not, because touristically you can't do anything. It's a board and the shareholders who decide what needs to be paid. We've seen in the context of listed entities where the boards can propose and the shareholders have rejected some of their proposals. So so it's a matter beyond. So there is nothing fixed about it. So dividend can be paid in 1 year and not paid in next 3 years, even though there could be profit. So there is no true way in determining this, and that you may just want to disclose it. Because it is definitely still a transaction, but it has no meaning because it has no arm's length that you may need to derive. Employment stock option plan is something that you may need to put whether in this clause or in allocation. But there could be some companies who do allocation and arrangements are there. So you may need to look at that. And recoupment received from A, I believe it still should be looked at under this clause. And there could be many more. We've just given a little bit of a flavor over here. Going to the next clause, and I think some of the important clauses are there. Sachin, I hope I can take 15-20 minutes more. I've not got a yes from you, but I'll presume that it's a Saturday and people may have a little bit more time. I know it's a busy season as well. Same for me, but I think important that we cover all of that. So this is deemed international transaction, and I think, and this is a very vexed issue, I would say. And we'll go through what is a deemed international transaction. Obviously, it's a deeming fiction that has been created, and apparently unrelated parties may become related parties and may have to actually report a transaction. This is a good thing to look at even from the other company's perspective. So there could be two enterprises, and let's just take an example over here. So there is A, which is for whom you are certifying 3CEB. There is A's parent. It has an agreement with a third party to give you services or to even take services, whatever way. Now, if this is the situation, the third party with you as A will have no connection as such. But since A is deciding the term, scope, and most of the tenets of the agreement, you become related parties from the deeming fiction. And this has undergone a lot of discussions to say what happens if this third party is an Indian entity. Even if it is an Indian entity, you may have to report it because it's a deemed international transaction. So that's number one. Number two could be, if there is a quadrangular. So if, for example, A's parent company decides with a third party, which is also outside India, for a certain arrangement to say this is the kind of services or whatever has to be provided or received, and this is the cost or the way or manner in which compensation has to be decided. And the third party is A, which could be in India, is then dealing with A, which I would say is a quadrangular. Now, fortunately, the way in which the agreement, or rather the statute rather, define, it is only a triangular situation which is covered and not the quadrangular. But to my mind, and with a lot of TPOs, we have seen that they have been asking these questions also, whilst we technically defend this to say that the statute does not let you go beyond a triangular one. A quadrangular one becomes a important aspect. So I've covered, I think, most of this on this slide. In fact, we've seen, and maybe I'll go to the next slides and then I'll cover that bit, whether it is 92 B2 that we have to look at. This is 92 B2, but there could be some cases where even beyond this we might have to go to 92 B1 itself, even though it is a third party or apparently a third party. An interesting thing is that if there is A's parent, A is there and there is A1, let's say, and you deal with A1, whether there is a reportable transaction, to my mind, no. If you are dealing with the other subsidiary or sister company of your group in India, you don't need to report, because this is not an international transaction. It may not even be a deemed international transaction. So very peculiar thing. Even if A has decided the terms and conditions between A and A1, there could be a good argument to say you don't need to report, because the way 92B2 reads is a transaction with an unrelated company is deemed to be an international transaction. If it is a related party here, then 92B2 does not apply. So there is this very peculiar thing, and of course subject to interpretations, etc. And I'm very aware that I'm walking on thin ice over here to make this kind of a statement. But there is a way in which you can probably have an argument to say that that does not need to be reported. We'll look at where you need to report it because there's a new clause now which has been brought in for related parties which have a different tax regime, and we'll come to that in the end. So suffice to say that these are some of the things. I think I've gone through most of this, but I think the The biggest thing is it is very difficult to identify. Let's say, for example, and I'll just give you an example over here and leave it at that. The foreign company has agreed with, let's say, Dell or HP globally to supply laptops or computers at a certain rate and a fixed price. Now, if the Indian company buys it, when you look at it from a 3CB, the Indian company would have reported some of these. You may go to the RPT, etc. Nowhere this will be coming up. You might have to actually do a proper ask of the company, or look at their procurement policies, or saying that, you know, the procurement team to discuss whether there are some of these transactions. Otherwise, you will never be able to make out whether there is a deemed international transaction of this sort. There could be other way to look at whether HP or Dell is also reporting that as a deemed international transaction, because for them also this is a deemed international transaction. So, but it may be outside India. You may not have no way to look at it. And as I said, quadrangular at this point of time, the view, at least for most of the professionals, is that the quadrangular does not apply. In my own mind, I would say, and again, as I said, I am standing on thin ice over here. My view is that when you are looking at a 3CB, you should look at it appropriately and make your own decision of what you want to report and whether you want to report. So disclosure will come out. Benchmarking is like any other transaction. So you know, you'll have to benchmark it like any other transaction. Of course, if it is working on a TNMM, and this part is a expenditure which is there and it is already getting you know, covered under the overall TNMM, you may want to say that, you know, overall TNMM covers that transaction. But again, there could be another viewpoint to say every transaction needs to be standing on its own, and it is a transactional net margin. It is not overall net margin, it is a transaction. So every transaction will need to be looked at separately, unless you say that aggregation is the right way to deal with over here. So quadrangular arrangements, as I said, we have a Kodak which is there, and again, as I said, in that also probably, if I think right, they said quadrangular arrangements not in 92B2, but it could be that 92B1 may need to be looked at. And I think that is something which may need to be a judgmental call. Again, you'll have to make a judgment of whether you need to look at 92B1 itself, because if there is in any way a suppression of income because of the transaction, then again, as I said, a professional call has to be made. So let's look at now specified domestic transactions. So, you know, clause 21 is there, 22 has been omitted, and 23, 24 has been pushed up there, and we'll come to that. I just wanted to ensure that we have the understanding of how the clauses run. So the clause 22 has been omitted. So 48 2B transactions are now not to be reported. So earlier transactions like you know, with your directors, etc., were to be given. Now this is no longer to be given. So and clause 24, as I said, is newly inserted for companies which fall under the newly form 115BAB, which is a lower tax regime that has been and then there is a residual clause, and we'll come to that. So these are changes which have come up on 1st October. So I thought I should mention this. So specified domestic transactions. Let's look at you know, what are the aspects that one needs to look at. We started with saying we will need to look at you know, transactions of ATIA 8, ATIA 10, 10AA transactions, 115BAB transactions, or any other you know, such regimes which are there. In aggregate, there should be transactions amounting to more than 20 crore rupees only then you need to report this transaction. There have been several questions, and we have been also grappling with those transactions. That what do we need to do? Whether GST has to be considered while doing this, and the answer could be yes or no. But I would say that the answer is generally, I would say, the transaction value, and I would say yes, because you are paying that whole amount. There could be another question to say, can you have a separate auditor for SDT and international transaction? Whilst you can, but there is only one 3CB that you have to file. So at the end, one person will have to sign off, and there is no possibility to have two auditors for the 3CB, as we can have probably. At least I have not come across any of these situations where you have two people signing. There is no ability to do that. So these are the clauses, similar. I'm not getting into these, but these are for goods or services both together. So 22A is for transfer of goods from one undertaking to another business, and 22B is for acquisition of goods by one undertaking to eligible business from another business. So this is for the eligible businesses, and this is for the transfer of goods from one undertaking unit to another eligible business. Let's go to some of the issues here, and I'm just trying to run a little quicker, so please excuse me, because I don't want to take too much of time also, and I don't want to get into the lunch time. We don't have a lunch. We all have lunch at our home or offices, wherever we are in this state that we are in at this point. So inter-unit transfer of goods from one eligible tax holiday unit to another eligible tax holiday unit is reportable under both these limbs. So just to ensure that it's not required that one is eligible and one other is not eligible, and then what you do, I think both will need to be then doing that reporting, and this has been upheld in the ruling of Wipro that it is actually not reportable, and I'm also a little confused as to why it is not reportable. The next one is allocation of common cost. I think this is an interesting one. We've seen that there are multiple units of the same company, and there are provision of services and allocation of cost. I would say that please follow what I would say is prudently to be done. Whether it is core function or it is a marketable function is something that you need to balance yourself with, and then say whether it has to be reported or not. Because if it is a non-core function and it is a simple cost allocation, you may not want to report that, because it's not a transaction per se. It is just an allocation. It has been done by only one unit, just to ensure that the cost is picked up by one. Okay, so let me go to the next one. And as I said, market value should be looked at. So this is a renumbered clause, and here there are various aspects that need to be looked at. Whether the company is making more than ordinary business from the eligible business, more than ordinary profits from the eligible business. Now, really speaking, this is something that the tax officer generally does, to make a judgmental call to say whether there is more than ordinary profits. And I'll not stick to the slide, but maybe some aspects that I had in mind. When would you make that judgmental call? Let's say you have a transactional net margin method done. You have your comparables from, let's say, 4% to 22% with a mean, or with a range, but let's say with a mean of 8% or 9%, let's say. Now, if the other entity, which is or the eligible business, is making, let's say, 12% or 14%, let's say, would you say that this is more than ordinary profits because the mean is 9%? Very difficult judgmental call, because you might want to argue to say that the highest in that is 22%. So every business is normal, and since my comparables are in that range, and every single point is at arm's length, I would contend like that, and therefore I would not say that it is out of arm's length. But again, a judgmental call to as to what you will want to say, because there are other aspects of saying, is that an arrangement? Because ATI 10 says about an arrangement to unduly or unjustifiably enrich yourself or the group, which is a difficult call to take. So I would say that, similarly, the newly inserted clause 24, which is there, which is on the companies which have got a lower tax regime. Now, the question here is, you may need to look at the Indian entities which have a lower tax regime. It may not be very forthcoming, or it may not be reported anywhere. You will have to make that inquiry with the company to say, do you have a transaction with a group company which is enjoying a lower tax regime under 115BAB? So it is for you to unravel that and then report. So reporting is fine, but unraveling is the most difficult, I would say, to put that. And again, as I said, how will you say that it is arm's length or not? Are they making better profits? I mean, they may be making better profits because they are in a better business, let's say, for example. Then you will have to see if that company is doing transactions with others, or making money from the transaction that you had with that entity, results into an abnormal profit as compared to its peers. Then you may want to use that, but it's a very difficult choice, and very difficult to assess that. So again, here is a lot of judgment that you will have to use. Let's look at the gist of 115 BAB. It is the concessional rate of 15%, new companies that have come up, and these are the qualifying taxpayers. I'm not getting into that because that's not my topic for today. So I will not get into too many things, but just as a reminder, I would say that please look at this qualifying taxpayers who are there. What happens if the company is qualified, but it chooses not to take that option? Then you may not have to report under 115 BAB. So you will have to ensure that it has qualified and it is going to take that rate. Now it has not filed its return as yet. So how will you make that? So you will have to take a management representation in that case. So all these aspects come into play. Let's look at what could be the transaction. It could be any transaction which could be there. So I've just mentioned some of these transactions just to give you a flavor of what happens, because based on experience of what within the group entities, why would, so there are SEs and entities, etc., and therefore there could be rent payments, for instance. The developer and the SEs entity could be the same, for example, or for that matter, transaction of royalty, brand equity, etc., human resources. So what would you do? Fair market value versus ALP, whether you can say that fair market value is synonymous with ALP. I would say that there is a difference between fair market value and ALP. I remember a few years back, I have actually written an article on whether fair market value is ALP. And I mentioned that, it's not the same thing. It's slightly different. Fair market value is what you will actually get in the market. ALP is something which is a determinant based on the method that you use. So there are two different aspects. What do you do if you do not charge allocable indirect cost, and whether you should charge or not, and whether it is an arrangement versus a transaction. Can you say that it is a transaction and not an arrangement? You may not be able to say that any transaction is an arrangement and it is synonymous, but whether an arrangement brings up more than adequate profits or not, and it erodes the tax base for India, I think one will have to make a choice on that. Other key aspects, and I'm just getting into my few last slides, secondary adjustment in Form 3CD and 3CEB, which is there as clause 30A. This is where the transaction has resulted into a primary adjustment, and then there is a secondary adjustment when the amount is taken as a loan, and there will be an interest accordingly. So primary adjustment is the transfer pricing adjustment which is happening, and the secondary adjustment is the interest if the income is not paid, and in the subsequent years it just starts accumulating what I call as notional income, which needs to be reported. I'm not again getting into this because this is not the subject for today, but it's a subject in itself, I would say. And there is a newly triggering section to say one time you pay off and there will then be no secondary adjustment. But there could be situations where the group company may not want to pay because, for instance, it has got a tax ruling in its own country, and therefore it is not wanting to pay that amount. So what happens to that? So that there could be various ways in which this could be triggered. So please look at this carefully. But relatively it should be simpler. But if there is anything, again, as I said, if you have any of these positions to be taken, please look at it carefully. If you want guidance, etc., feel free to call me or send me an email, and I will try and respond to it. So other checks and balances, I would say these are more important and I would say very topical. It is the responsibility of taxpayer to identify, but it is equally your responsibility because you are going to sign off. So obtain all list from enterprise for the A. Even though they have not transacted, you might want to just go through the names, etc., just to ensure that nothing is left out. Review the filings that have been done with various regulatory authorities, not only one. Review stockholder listings of closely held companies. You will get a good idea of if there are some things which are there. SEBI sometimes lists all the people and companies which are treated as group companies or promoter companies, and you may want to pick that up. Review material investment, review the related party disclosures in the audited financials, and you will have a comprehensive view. Look at the corporate registers, and that is also another good point to look at. GST, as I mentioned, GST returns could be one other aspect that could be looked at. The other is, talk to the taxpayer, to their personal, and interview, if possible. Do that. I think that is, we have found this to be extremely useful. Even at sometimes, the taxpayer, where you are in connect with the tax head or the CFO, etc. They sometimes miss out on some of the transactions because they are also not aware. When you talk to a MD or the head of the company, then you will have probably a better view. Look at whether APA has been signed and whether 3CB then is required for transactions which are not covered in the APA. So transactions which are not covered in the APA still needs to be reported. So 3CB still has to be filed. So do not miss out that. We've seen that some cases in the past have happened in the last 2-3 years. I've seen that 3CBs have been missed out because the taxpayer feels the APA has been signed off and therefore nothing. But APA has been signed off for only a few transactions, and there is a list of transactions. Anything beyond that needs to be reported. So do not forget that. Exchange rate in the 3CB versus income tax computation is very much to be looked at. 3CB you will report perhaps at the rate at which you will have booked in the Indian company whereas the reporting of the foreign company in its own return will have a different number because of the rules that are there in the income tax rules. So there may be some mismatch which you will have to ensure that it is reconciled and kept. COVID-19 impact disclosed in audited financials. Please look at that, whether it has any impact. Too early to say what people are going to report. We are still struggling with our audit team also to ensure that, what is it that you will report? How will you call out those details, first of all, whether that has been the impact or not. So again, responsibility of taxpayer to give you all of these items that are listed out, but no substitute for your own checking and as you do in an audit, please have the same sanctity and the same diligence for a 3CEV. So some of the last remarks I would say, and as I said, we'll close this. How you go across, verify nature of transaction, what are international, what are FDT, provided by the taxpayer, and make a good judgment yourself. Reconcile the Form 3CB with related parties, with notes to accounts, identify discrepancies, and then put down. Review the intercompany ledger as well, and I would say corporate registers also. Look at CB filings. Additional cross-checks, look at forex earnings which are reported, CIF value of imports, notes to accounts. Undertake the test checks for invoices. So do not just go with whatever is given. Please look at some of the invoices and agreements. Look at some of the terms which are there. Compare last year's, which I think we all are good at, but sometimes we miss out. Look at the last year's 3CB with current years to ensure that some of the continuing transactions don't get missed out. Or if you have a transaction this year, why was it not there last year? And then do we need to revise that last year's 3CB? Classify properly, as I said. Some of the transactions are so involved that you may need to make a call. You may need to take a call on which is the appropriate clause under which this falls. So that's another important thing. Documenting, again, as I said, irreplaceable thing. Documenting your position based on judicial precedents, accounting standards, or guidance note. Whatever you have done, please put it on record. And do not forget to prepare the notes to the 3CB. File that, get that file. I mean, you may not be able to file, but obviously the taxpayer has to file and keep that copy with you, so that if you are questioned as a professional, and I have seen that some TPOs have called professionals, and this is the most embarrassing if a professional says, I do not have, I have just signed off. I think that is unforgivable in my words. To say that we did not see. You may have taken a wrong call. That's fine, but you have taken a call. You have made a judgmental call, and you may have an assumption. You were given a wrong assumption, or you are basing your thoughts based on some of the wrong things that could have been presented to you. But at least you have done your bit of diligence. Should be very apparent. So obtain management representation. I would say that's again infallible. Even though you have reviewed, you have done. Please take, as we take in a statutory audit, please take the management representation here also. So with this, I have taken more time, but I kind of close this over here. My contact details are here. As I said, if we are not having the time enough because I have run out of my time. Sorry, I went a little bit above Sachin and Mehul, I think, but please pardon me for that. But I just wanted to ensure that I do full justice on this Saturday afternoon, fully knowing, or maybe with a lot of assurance that we will have a date extension. So that's the end of it. I don't have anything further to add, but